Getting a mortgage right now is different than it was even a year ago. And if you go in without a plan, you're going to leave money on the table, or worse, you're going to get stuck with a rate and a loan that costs you tens of thousands of dollars in excessive costs over the life of the mortgage. I've been in the industry for over a decade. I've closed thousands of mortgages. I've been a top realtor, built and sold an insurance company, and now I'm the top 1% of mortgage brokers in the entire country. So I've been on every side of the process, and I'll tell you what works and what doesn't, and what most people get completely wrong. So in this video, I'm going to walk you through exactly what I would do if I needed a mortgage this year, from start to finish. When to start preparing, how to position yourself to get the best rate, the mistakes that cost people thousands, and the moves that people don't even know exist. By the end of this, you'll have the full playbook. The first thing I do is start preparing way earlier than people think they need to. Most people start thinking about their mortgage after they find a house, which is the opposite of a good idea. It's already too late. You want to be working on this 6 months to a year before you're ready to buy, and I'll explain to you why. You actually can get pre-approved this far out, and you know exactly what you qualify for, not what you hope you qualify for. And that will also tie into something very important that people forget about: your budget. Yes, that favorite household word. And all of this directly affects your rate and your purchasing power. Once you do this, your pre-approval, and get a really good lender, they will advise you on 4 critical items during these 6 months. First, you can fix your credit issues. Secondly, you can strategically pay down the right debt. 3, you can save for the optimal down payment. And 4, you can build up reserves. The reason I say optimal is because sometimes a lesser down payment can actually get you a better rate than a higher down payment. So it's important to talk to your lender about this. Now let's talk about what you actually do at that time during those 6 months, and starting with your credit. Everyone knows credit score matters, but most people don't know exactly what moves the needle and by how much. Here's what I would focus on. First, credit utilization. Most people think 30% utilization is good enough. I've seen score boost the best at single-digit utilization. This is the optimal number. I've actually seen things go up as high as 50 points when done correctly. So here's what this means. If you have a $10,000 credit limit on a card and you multiply by 0.09, that's 9%, single-digit utilization, just under 10, that's $900 or less. So you want your balance on that card to be somewhere between $1 and $900 to give you the highest credit score possible. Next, strategic debt paydown. This is not what people think. You have to let your lender tell you which are optimal, because they're looking at debt to income ratios and not focused on debt balances, which is a lot of times what you're looking at. So you can also exclude certain debts. So let them guide you here, because that's going to be key to make sure you're paying off the right debts. Next up, you can become an authorized user on someone else's card. And this is a great way to boost credit most of the time, but you have to make sure that they have a low utilization and excellent payment history to see how it impacts you. I've actually had a client from Mexico. We went in contract in Washington, D.C., and she didn't even have a credit score. We were able to get her added to an uncle's credit card, and the scores populated before closing. This was lightning fast, and it worked incredibly well. So these strategies do work if done properly. Here's what not to do. Don't take out new trade lines of any types at all when you're trying to buy a house. No zero interest payment deals from Best Buy or Klarna where you buy before you can actually afford. Stay far away from these. By using these strategies, I've had a client come to me with like a 590 credit score. By the time we were ready to close 3 months later, they were actually at a 720. That difference alone got them such a much better interest rate. It's going to save them about $36,000 over the life of the loan. That is significant. All right, so now you're pre-approved and your credit is dialed in. Now let's talk about what's actually happening with rates in 2026. Now here's where 2026 gets interesting. A lot of people have been waiting for rates to drop. And honestly, I get it. But here's what I'd actually do. It's always best to buy before the rush. And the rush happens after rates drop. This is a very simple supply and demand concept. When demand goes up faster than supply, prices go up with it. Think of an ocean wave. You never want to be in front of the wave or too far behind it. It's best to ride and sit on top of the wave. And the way you do this is you buy before rates drop and then refinance afterwards. It's important you find a lender that can not require lender's title insurance and also waives their lender-related fees. They essentially call this the free refi. It's not free, but it's free in the eyes of the lender. You still have county and local stuff that you got to pay for. Well, here's the math comparing two buyers, one that waited and then one that didn't. So buyer A is buying a $400,000 house, and they're going to lock in their interest rate at 6% on a 30-year mortgage. Their payment is going to be $2,326. Buyer B decides they want to wait a year for rates to drop by 1%. So they're looking to get a 5% rate. So in that year, because rates drop, we can assess that the appreciation will be at least 7% in a good market, year-over-year appreciation. That means the house is now selling the exact same box for $428,000. At 5% interest rate, both of these are with 3% down payment, which is the minimum on a conventional loan. That puts your payment at $2,228. So buyer B saves $98 a month. A total savings of $1,176 for 1 year period. Now here's where it gets interesting. If buyer A refinances their $400,000 home, it's going to cost them approximately, in let's say like a Houston, Texas, around $4,000. So their total cost is going to be $4,000 plus the higher rate, which was $1,176 in extra payments. That total is $5,176 that buyer A spent, and they now have the 5% rate. As opposed to buyer B who waited, they've paid an extra $28,000 for the exact same house. So what would you rather be? Buyer A or buyer B? Would you rather spend $28,000 or $5,000? Nobody can time the market perfectly, but this strategy works regardless of what rates do. That's why it's so important. Now here's where most people really mess things up, and it's choosing their lender. Most people get their mortgage from whoever their realtor recommends, or they just go to a bank or whoever's on the Super Bowl ad. And look, sometimes that can work out fine, but you're potentially leaving thousands and thousands of dollars on the table, along with a tremendous risk that you definitely need to avoid. For us, as a broker and correspondent lender, our team can shop 20 plus lenders for you. That's literally our job. But if you don't work with a broker, at minimum, be very, very cautious of lenders that spend billions on advertising because they're just not focused on operations. And this can create massive risk for you. When a Rocket Mortgage doesn't pre-underwrite your file, nor do a detailed due diligence, do you think that they're going to reimburse that earnest money deposit that you lost because your financing just blew up? No freaking chance. I've seen companies like Rocket, along with others like credit unions, do this so many times to clients, and it's quite sad. You know what they say? Friends don't let friends ride that rocket. All right, you've picked your lender, you're ready to apply. Now here's where deals fall apart if you're not careful. You'd be amazed at how many deals die between application and closing because of completely avoidable mistakes. Here's what not to do. Don't make any big purchases before closing. Cars, boats, furniture, etc. Just don't do it. And don't change jobs, and definitely don't go self-employed. That can absolutely kill you. Avoid moving around money without a paper trail. And also, no new credit accounts at all. That will crush your debt to income ratio. And lastly, don't get married or divorced, not even in Vegas. And if you have a question about this, just ask your lender. That's what they're there for. I had a client who bought furniture for their new house 1 week before closing on credit. Their debt to income ratio got crushed. Let me show you how. They had a $10,000 furniture loan divided by 4 years, divided again by 12 months. This added an extra $208 in debt per month. We had to scramble last minute to save the deal. Don't be that person. Okay, you've made it through the gauntlet. Now let's talk about the final moves that can still save you money at the closing table. Most people think once they're approved, it's done. Just sign and move in. But there are still moves you can make. You must have someone highly seasoned and that you can trust to help you review closing disclosures. You got to look for those hidden fees from all parties involved. The lender should be perfectly aligned with the title company and the insurance agent to make sure your budget can be met, not only from a monthly payment perspective, but for cash to close. This is critical. Your real estate agent should be negotiating with the seller to get the most seller credits possible, not just trying to get you in contract so they can get their next commission check. Look, having been on all sides of the real estate deal, the mortgage, insurance, I can tell you these pieces all connect. When you have someone who understands all three, you can catch things that slip through the cracks. So that's the playbook. Start early, position your credit, understand the rate environment, choose your lender strategically, don't blow it during the application, and close strong. If you do all of that, you're going to be better than 90% of the people getting a mortgage in 2026. Now you've got the mortgage side dialed in, but the mortgage is just one piece of buying a home. And if you're a first-time home buyer, there's a lot more you need to know before starting this process. So click this video here because I put together the complete guide to buying your first home. Everything from finding the right agent to negotiating your offer to the stuff nobody tells you until it's too late. If you're serious about buying in 2026, that video is going to save you a lot of headaches. I'll see you there.